Hello and good afternoon. You tune into Market Fatafat. I'm Ankita Saxena. With me is Shesha Adwario, and in the next half an hour, we'll take you through all the stocks that are in focus in today's trading session. And one stock that's doing very well for itself in a volatile market as today is Satin Creditcare, that's trading up 5% on the back of good set of numbers coming in. Let me quickly take you through the numbers first. As far as the PAT is concerned, we're seeing an uptick of 636% on a year-on-year basis. Total revenue also up 50% on a year-on-year basis. The reported NIIs are also up 53%. We also see the PPOP that's up 127%, and we also see a couple of metrics, other metrics like collection efficiency that remains strong. Their credit costs have also declined, and their AUM has also grown 92% on a year-on-year basis to 1,054 crores. So good set coming in for Satin Creditcare. On the back of that stock is buzzing in trade, and now we have the management, H.P. Singh, Chairman and MD, Satin Creditcare, who's now joining us. Mr. Singh, hi, good afternoon, and thank you so much for joining us. Mr. Singh, you reduced the credit costs, materially in FY26. As I was reading the numbers, it's down 77 bips on a year-on-year basis to 3.8% now. And also sequentially, you're seeing a dip there. What led to that, and what is the normalized credit cost range management is management underwriting the business for over the next 2 to 3 years?
So I think, what we've been able to do that, we gave a guidance that our credit cost will be less than what FY25 had. FY25 was about 4.6%. We said that, we'll be below that. We've been able to close it at 3.8%. The reason has been that we have been able to underwrite very well. We have been able to manage the collections very well. We have been able to do the analysis of acquiring a customer very well. I think, everything put together for us actually led us to a decrease in our credit cost from here. When we talk about our guidance for the next year, we've already given a guidance that we'll be closer to the band is about 3% to about 3.5%. That is where the band is going to be. But having said that, we will try to see that we are able to achieve much better than that. When I say this, it is because in Q4, we actually did a credit cost of 2.2%, so which is probably, much below what 3% would be, So we look at that guidance, for the next year as such.
Understood. And Mr. Singh, let's also talk about AUM, because that has grown by about 19% on a year-on-year basis. Can the company sustain 18 to 19% AUM growth while keeping return on assets above that 2.5% mark and maintaining conservative credit costs going forward?
Yeah, so growth, again, we've given a guidance for growth also for the next year. We said that microfinance will grow by about 15 to 20%, which means that, the range is between 15 to 20%. But when you look at the consolidated, our subsidiaries, actually MSME subsidiary actually grew by about 90%. The housing finance subsidiary grew by about 38%. When I put this together on a consolidated basis, I think, we would probably be growing at about 25%. Standalone microfinance at between 15 to 20%. And when I say this, again, we say it with this, that this will have a positive impact on the ROA, definitely. Credit cost, which I said earlier, is going to be less than what we did this year, 3.8%. The range is again 3 to 3.5%. So when we combine all this together, growth as well as ROA, as well as credit cost, our ROA will practically be much better than what we have this year, what we've done. So I think our ROA was about 2.66%. I think we'll be better off than that in the coming years as such.
Right. So the cost of borrowings have fallen by 43 bips on a year-on-year basis as borrowing cost is declining. Do you expect spreads to expand further, or will the competitive pressure force the repricing?
No, I don't think so. I think, we are comfortable with our yields as well as our NIMs. Cost of borrowing, according to, the rates, which the repo rates, which hang on across over there, I think we're fairly stable on that. We don't expect that there's going to be an increase in the cost of borrowings, nor do we feel that there's going to be a lot of decrease in the yields which we have. NIMs will remain stable. Cost of funds will definitely be stable at that, but there could possibly be a decrease also. But I think right now what we're talking about is just pure stability in terms of cost of borrowing as well as in terms of our yields and NIMs also.
That's as far as credit cost is concerned. But Mr. Singh, what are the key drivers behind the sharp improvement in return on equity that has come in at 23.3% in the fourth quarter? And is this sustainable over the medium term?
See, again, the last quarter is always the best quarter. So when we encompass that, again, ROE is a combination of ROA as well as, the profitability, which is probably been there. So putting everything put together, I think for us, since we are not doing any kind of a capital raise right now, what I feel that this is again going to be on an uptick. If our ROA improves, definitely my ROE will also improve. And this is what we're looking at a positive sign in the coming future as such.
Right. Also, the non-MFI businesses now form 17% of the AUM with a target of 30% by FY 2030. Which verticals will drive most of this transition?
So as you know, we've got 4 subsidiaries right now, and 4 subsidiaries out of that, 2 is in financial services, which is housing finance and MSME lending. Both have actually done good growth in the last year as such, 90% for MSME and about 38% for housing finance. Besides these, we've got 2 subsidiaries for us, which is Satin Growth Alternative Limited, which is an AF Category 2 fund. It's a very fundamental fund, which is being led by an all-women's team. We feel that, as we have soft commitments to the first close over there, that will also be a big kicker for us in terms of our growth happening across in the next 4 years. Besides that, we've got a technology company. We've just invested into and acquired a cybersecurity company, which is going to be post-quantum cryptography. Looking at all these 4 factors and the 4 subsidiaries which are there, I think that's a huge growth kicker for us in the next 4 years. And that's the reason why we've been able to revise our guidance in terms of our non-MFI, place to be 30%. And we've revised our target from 25,000 crore to about 32,000 crore, by 2030.
And Mr. Singh, what is the biggest risk to achieving the 32,000 crore AUM target that you have set for yourself?
I don't think so. I think, what these subsidies actually require is capital. And I think, that is probably the prime concern for any startup or any kind of a young company to probably accomplish, Thankfully, and if you look at it, we are very comfortable on our net worth on the parent company, which is close to about 26%. Having said that, if capital is not a constraint, for them, the growth will not be a constraint. So I think, for us, it's a very clear standout, which is going to be there. Since capital will be there with us, for us to grow, reaching this goalpost is not going to be challenging or difficult.
All right. On that note, Mr. Singh, thank you so much for taking the time out and joining us. It was a pleasure to have you on the show. And well, with that, it's time for us to quickly slip into a short break. Don't go anywhere. After the break, we'll continue with the market updates, so stay tuned.